The analysis is on Parag Parikh Flexi Cap Fund. This fund has been in existence from 24th May 2013. Prior to that, these similar people were running a PMS house. So Rajiv Thakkar is the fund manager. He has been running this fund since inception. So he's one of those fund managers in the industry who have been with the same fund for more than 10 years now. So the investment strategy again is similar to other funds to generate a long-term capital appreciation. And one of the one these fund actually invest around 20% in the foreign equities. So now because of that RBI regulation, not just Parag Parikh Flexi Cap, no other fund house is investing much outside India, but the existing funds, whatever are outside, they can reshuffle that investments. That's what they said in one of the con calls. So if you look at the exit load, so typically for most of the funds, the exit load is only for 1 year. But for this fund, it is like for 2 years. So if you are redeeming before 1 year, that will be 2%. And if you are redeeming between 1 and 2 years, this is 1%. Ideally, you should not even look at investing in the equity products if your horizon is less than 5 years. If there is someone with a 5 year horizon, then the exit load shouldn't even matter to you guys. And the benchmark they are using is Nifty 500. The current AUM they are managing under this scheme is 88,000 crores. But unlike other fund houses, this fund has only one pure equity scheme, that is Flexi Cap Fund. There are two hybrid strategies, and then there are liquid and arbitrage strategies, but that's not the case with the other fund houses. So that's the reason why AUM is on a higher side. So usually whenever the AUM is growing, people tend to split the funds into multiple funds and they manage it, but these guys prefer staying with a bigger corpus only. So if you look at the expense ratio, the direct is at 0.63%, the regular is at 1.33%. So this is 0.7% extra, but typically a distributor is making around 0.55 to 0.6%. The rest all is again for the marketing expenses and the other expenses. So if a financial advisor is recommending this fund, and if they are charging 0.5% plus GST, typically they make what a distributor is making. And if somebody is charging more, then they will be making more than what a fund manager is making. And at the same time, this shouldn't be the only criteria for you to choose an advisor or a distributor. You have to check their credentials. Why are they recommending? Whether their research is adequate or not. Whether their recommendations are suiting your asset allocation and goals or not. So if that's the case, then it may be worth paying to the distributor or an advisor. Otherwise, you have to do your own due diligence when you are investing. If you do not have one, then you have to do your own due diligence before investing in any equity product. Right. Now let's look at the analysis of the fund, how it has done across various when compared to different indices, Sensex, Nifty 50, Nifty 500, and Nifty 100. So if you look at the direct scheme and the regular scheme, they have done extremely well when compared to the indices. So across the time horizons, they have delivered a very good returns. So even when we are ideally, even 1 to 3 years shouldn't even matter when you are looking at it. But if you look at it, the negative instances have stopped from the year three. Right, even a regular there is 0.05%, but again it is really very small, negative 0.17%. So if you compare that with any of the Nifty, any of the indices, that is between 4% to 8%, right? And again on a 5 year, 7 year, on a 10 year basis is very interesting. If you look at it, the median return is at 19.53%, max at 21.56, the minimum is at 17.3. So this is what separates this fund from the I mean like indices and even for the other funds. The reason is if you look at the minimum to maximum, the difference is around 4 percentage points, and the median is between. Now let's look at the Sensex or Nifty 50. So the minimum to maximum, again there is a 4 percentage point differential, but that is at a lower rate. That means the returns have been smooth, at least for this fund in the past. But again, past returns you cannot extrapolate in the future. But again, this is something which they have done well. But the AUM sizes in 2015 was like really very small compared to what they're having now. We have to see how they'll perform with a bigger AUM. But their past performance have been really good. We do not know if that will be possible in the future again. right? Now let's just look at the stocks, how they have done in the past. So this is a 10-year data. So if we look at the highest weighted stocks, that has been Zydus Wellness at that point of time till 2020, till the 5-year time. So if you look at it, so typically they are having around 25 to 30 stocks, right? So both Indian and foreign put together, at that point of time, they had a 96% of it invested. And if you look at this fund house, they are consistently maintaining some amounts of cash depending upon the market conditions. Presently, this is the January data at 20%. I think in the March data, they have a slightly higher amount, if I'm not wrong. Uh, so if you look at it, they are the ones who are taking. It's not exactly a cash call, but if they're very valuation conscious fund house, and if they don't think there is much value in the market, they usually go with the cash calls. Usually go into cash, which will generate them around 6-7 percentage kind of return. So if you look at what has been there in January 26 and compare with 2020, so which is at 96%, right? So in 2020, same stocks were there of 44 percentage points. That means half of the portfolio got churned in 5 years' time. That is like every year. So there is a 10 percentage points of churn, right? And let's see what has happened from 2020 to present, what was the case, right? 2020. So this is 80%. So they were sitting on some cash before the COVID crash. Good for them. That's the reason why these guys have a better downside protection. Whenever you are going for cash, again it will perform. It will affect your performance when the market is going up, but during the downturns as well, it will preserve your performance. So if you look at 2025, they have approximately 36.5%. That is like another similar something like a 50% of it is whatever is there. So if you look at it, this fund house is maintaining a decent amount of whatever they are having. They are holding it for a longer durations, right? So every year, if 10% is what you are churning, so that means like a typical holding period can be like almost 10 years for any stock. And whatever we are having in, so close to 75% of whatever was there. So in 2024 as well, it is something like a 74 to 75% only. There was one stock which they have exited, I mean, like which they have come into in the 25, right? 23 when compared to, again, it is at something similar levels, right? 75 to 72%. So this fund house actually churns like they take really very long-term decisions, and probably that will give you an advantage on the cost side as well. You're not somebody who is repeatedly churning, not churning the portfolio, then your brokerage cost will be less, right? So if somebody is having that means if you are saving some amount of cost, it will add to your return, because other fund houses and everywhere else, there is some amount of churn which is involved that results in an extra payout. So let's look at how this fund has performed in charts. So from 2013, pretty much till 2014, the fund performance has is similar, right? After in 1.5 years time, there was a divergence. And even if you're looking at certain patches, right, the performance would be something similar. Say for example, December 2016 to 2018 January, the returns have been something similar, right? Around 35%. But only good thing is like whenever the market fall is steep, their fall is slightly lower. So that is giving them a higher performance. Again, the reason why they're having a lower, I mean, like less steeper falls is because of the cash they are holding, right? Let's look at 2019 to today as well. So from 2019 till 2020, the performance has been similar. But if you observe during the COVID fall, when the market was down by 31% from 2019 January, so these guys were down like 7% when compared to 2019 January. So an additional whatever you are having the 14, 15 percentage points of return, right? Even if you are performing something similar to the market, that will give you great additional returns. So that's what is happening with this fund. And from 2013 to today, if you look at it, uh, again, there are not many steep climbs and not very steep falls. But if you look at it, so just being on an even keel, they have generated huge amounts of return, right? So whatever was 100 rupees, so they have generated a absolute profit of around 770%. Compare this with the index, which is around 350%. If you look at the regular and the direct, the differential is not much, right? So this is 700% and this is 750%. So 50 percentage points difference is there. That's over a long period of time. But even the regular and the direct has been traveling in a very good, in the similar tandem again. So this video is for an educational purpose only. It is neither a recommendation to buy nor sell the asset class in discussion. And the past performance is not reflective of the future performance. That is something which you have to understand. Whenever you are choosing a fund, you have to see if it is fitting your asset allocation and if it is fitting your financial goals. If you are somebody with a distributor or a advisor, you have to definitely question them on this. Thank you.